With me on the line now is Capital Network's oil and gas analyst Lionel Thoron, talking through GreenDragon Gas's full-year results for 2016. Lionel, good morning.
Hey, good morning, Andrew.
What's your first impression here, Lionel, of the results?
Yeah, so this morning, April 27th, GreenDragon Gas published its full year 16 results. And I think here I want to first highlight a number of the positives. First is the production improvement in the GSS block with a 34% increase, so quite positive. This is due to a change of compression equipment that the company has started to implement at the end of last year for the production wells, and that improves the throughput through the infrastructure. So we should see some more of that improvement during this year in 2017 as the full year impact comes in. We believe this could be the start of a turnaround in production performance, which is an area that GreenDragon Gas has lagged a bit in the past. As production continues to improve in the GSS block, as I just mentioned, but also as the new drilling program commences in GCZ, which is another producing asset, on the back of the recent approval of the development plan by the Chinese authorities, which occurred on April 18th, so very recently. So in terms of production, just looking at that, I'm very encouraged by the performance. Even if at 3.4 BCF for the year, it is slightly lower than my forecast of 3.7 BCF, but it's there. It's essentially a timing issue, I believe. Otherwise, I am also encouraged by the focus of the management on fixing the strength of the balance sheet. And they are talking about a number of options. First, which we obviously know, is the refinancing of the debt, which they need to carry out. There's also the selling of the non-core and loss-making retail business that we can talk a bit about later. And also they are exploring an alternative listing in Hong Kong. So that's kind of the snapshot.
Well, in terms of the numbers themselves, Lionel, what do the financials look like? How do they shape up?
So at the aggregate level, the financials are negatively impacted by the very poor performance and almost $7 million losses of the retail business. So that kind of, blurs the picture a little bit for the underlying CBM business. The good thing, obviously, as I said, is the disposal of the business should be completed by mid-year. That's what the management says in the release. And that obviously will eliminate the losses and will also provide a clearer picture for the underlying CBM business, because then the reporting will be just about that business and we'll have full transparency on that. So in terms of financials, the revenue for CBM was up 17%, and the gross profit was better than my forecast, meaning that actually the cost performance was better than expected, even though, as I mentioned, the production was a bit lower. So I believe this is positive, and combined with the turnaround in production I alluded to earlier, I think that bodes very well for 2017. Now, down the income statement, all items were lower than expected due to, in particular, negative one-off items in the SG&A expense, and also a bit higher financing costs. So the net loss for the year was $12 million versus my forecast of $8 million, and free cash flow came in as negative $4 million versus my forecast of a positive $2.8 million. The capex was a bit high as well. Hence, a mixed financial picture. Performance, but things I think are looking up for 2017 and 2016 could mark the inflection point on that front.
Well, speaking of 2017, Lionel, what's the main focus here for them, do you reckon?
Well, obviously, besides raising production, management is focused on fixing the balance sheet strength by refinancing the debt, selling non-core assets, and they're also mentioning a potential listing in Hong Kong. So taking those in turn, refinancing the debt is a must, and we know about it, and it's been flagged, and management expects to complete it in the first half of 2017, and they are exploring all options at their disposal, including tapping the renminbi market, the Chinese currency market. So there's not a lot more we can say at this stage, and obviously it remains one of the risks that the market sees in the shares. Second is the selling of non-core retail business. We have already talked about that, so it's obviously a positive, and that should be completed by mid-year. So obviously we'll be waiting on that. Now, an additional listing in Hong Kong could be a natural thing to do, obviously, given that operations are located in China, and there are comparable companies listed on that market already, such as Asian American Gas. But management might have to provide a bit more details on the intention. So I would say let's watch this space.
Watch the space indeed. Very good, Lionel. Thanks for your insight.
You're welcome.
Capital Network's oil and gas analyst Lionel Theron there talking through GreenDragon Gas's full year results for 2016.